historical risk premium. Okay. Is there any problem with using historical premium? Okay, page 39 and 40. 40 is the one, right? Going back in history is okay, but it's noisy, and then there's no guarantee that the future will be exactly like the past. Okay? What you experience, what you will experience in the future will be totally different from what your parents experienced before. Okay? That's why they say that scold you, say, that doesn't make sense in our generation, right? Future is different from the past. So, noisy estimates, that's one thing we have to worry about. In the recent past, may not have good implication for future. Long in past, maybe 100 years ago, okay? That may be better in the sense because those rare events, okay? Like Lehman Brothers financial crisis. That thing happened about 100 years ago, okay? Over the last 50 years, we never had that kind of crisis. So one of those rare disasters, those things may be available in a long time ago. Okay? So go back in history as much as you can, okay, to have some more precise estimate of it with lower standard error. Another problem about using historical data is the survivorship bias. What you mean by survivorship bias is this. S&P 500, okay, for example, or Kospi 200, those are the index based on the largest market cap companies, the most successful companies at each given point in time. Last year's most successful 200 companies are not necessarily the same as this year's most successful 200 companies. Some of them dropped out, right? For example, in S&P 500 index, 30 or 40 years ago, there was a huge company called Control Data. Okay, Control Data. It was equivalent to Google or Apple these days. Okay, it was bigger than IBM. Okay, in MIS. It was stationed in Minnesota. Okay, Minnesota. This company drove the school to be more famous about MIS discipline. Okay, information system. Later on, it dropped out of the index. Somehow the company management was not successful, dropped out of the index, and taken over by British Telecom. It's just a division right now. A part of it was sold to Cray supercomputer. Supercomputer part is there. But what I'm trying to say is, these guys, the guys that used to be successful, drop out of the index. It's not captured by index return. Some companies may have gone bankrupt. For example, Enron, right, was one of the biggest companies in the US, and then all of a sudden it just went bankrupt. Before that, they were in the index, but their bankruptcy, right, must have generated negative 100% return. But by the time they were bankrupt, they were out of this index already, so much so that their miserable return was not captured in S&P 500 index. Okay? So if you are focusing on only the successful survivors in the market, you will bias towards having rosy pictures about the better return for the stock market, higher return. You will bias upward for that market risk premium. Okay? So you have to watch out when you're using historical premiums. Now, excuse me. And then, across different countries, U.S. market premium 4.4%. What if we exclude the U.S.? A lot lower, 2.2%. Why is that so? Because here's another survivorship bias. Because US has been the most luckiest, successful stock market over the past 50 or 60 years. Okay, unprecedented in the human history. If you look at the stock market of Austria or Netherlands, right? They started like 200 or 300 years ago, and then their stock market has suffered from huge crisis, like not just a crisis, but they've gone through World War I and II, and their systems was devastated. So if you are focused on those markets, the market risk premium will look a lot lower. Okay. So the U.S. market focused ones is a lot more biased upwards in premium. Okay. When we look back in history. And then emerging market valuation. If your company is headquartered or stationed in South Korea, Brazil, or emerging market China, right? Is it safe to use the market premium that we got from the U.S. market? I think that's a valid question. So people come up with different ideas, but there's no consensus so far, unfortunately. The textbook author suggests, why not we use something called country risk premium? Okay, what more premium do you want? Because already we are suffering a lot from market risk premium. But this author says, well, because we can either bump up the market risk premium because the China market, Korea market is riskier than US market, let's bump up the premium and multiply it. Or you can think about some separate risk factor called country equity premium for that specific country and add it to CAPM so that your cost of equity will be higher. That's his idea. But international CAPM wise, that's not consistent. International CAPM says, one risk factor in the market which should explain everything. You don't need to worry about those country premium. And then another group says, let's not use country premium, but let's build up scenarios, okay? Korea or China in good state versus bad state. Do the valuation separately, and then figure out their probabilities, assume their probabilities of good state and bad state. You got the valuation number for each case, cross multiply, and then get the expected value of your company. Okay. So the second approach I'm going to explain a little more. Okay. Country equity premium is not going to be tested in our exams, but it is still in the textbook, and then the CFA exam talks about it. So just go through it in your free time. Just to briefly show you what is going on in the textbook. They try to model this country equity risk premium and factor into the discount rate in 3 different ways. And then this guy will have 3 subdivision of different ways of approaching country equity risk premium further. So it's a lot more complicated, screws up your mind. So I say, forget about it. Okay. Some problem sets that I distribute will have country equity risk premium, but ignore that part. Okay. So for example, what do you do? In the Brazilian company, beta is given, market risk premium is given, and then risk-free rate is given. Now the textbook author throws out country premium as such, 8% or something. What I say is, forget about this part and just do the CAPM, that's it. Okay? Now what? Well, that's for the problem set part. Forget about the country equity risk premium. And if you are unhappy with that, and then why not we use that, the scenario-based approach. Here's an example. Okay? So for first, project the cash flow under the assumption of normal business situation, and that's called the VEN, and normal. Right? And then distress situation value, okay? When the country is bankrupt, okay? All the bad things happen, but you still, do your business because you're a businessman anyway. Okay? And then the problem is, then cross multiply your value in each state, and then the probability in each state. See this probability over here is bad state probability, and 1 minus p is the rest. Okay? Now, can you throw me some example? Well, here's a company called EE with a cash flow of 100 million. Okay, 100 million. Next year, expected to grow at 2% forever. The risk-free rate is 2%, beta is 1.5, market risk premium 4. So using CAPM, the cost of equity is 8%. Makes sense? Now what? Using Odin growth model, okay? Next year's cash flow divided by R minus G. That's 1666. 0.667. That's the value when the state is good. Well, the company is actually in an emerging market, and we know that there is a chance, high chance, that the country will collapse somehow, disastrously, with the probability of 20%. Okay. Still make money somehow, but by half only, 50 million. So the value in the number will be half of this guy. Now what you do is cross multiply those values with probabilities of each state. Make sense? So that your expected value will be 1500. That's how we do it. So that concludes our discussion about historical risk premium, and we move on to implied equity premium. Implied in the market. So if we assume that the stocks are correctly priced in aggregate, and then we expect the cash flows from buying stocks, we can estimate the expected rate of return on stocks by computing an internal rate of return. I hope you remember this IRR approach in your finance fundamentals course, financial management, right? IRR. The rate that makes your NPV equal to 0, right? Investment amount equals present value of future cash inflow, right? So IRR. The idea is your index in the market cap of the whole stock market today, S&P 500 companies market cap, is equal to the future cash flow coming from that 500 companies, okay? Discounted at some mysterious market return, we just don't know. And then assuming some growth rate of this cash flow forever, okay? It could be simple one-stage model like this. Alternatively, it could be some more complicated stage model. The idea is, what is the rate that equates these two, right? What is this mysterious rate? Figure out. Then subtract out the risk-free rate out of it. Okay? Now, what? This. Okay. Is it better? Any? I hope. And then, compared to historical equity premium, this implied premium is more advantageous. It's better because it's forward-looking, not backward-looking. Okay, not backward-looking. Now, right? It takes the number in the market as it is, and then figure out the unknown. For that part, we need some more information. Okay, we need some more information. For example, well, cash flow to those 500 different companies. How do we figure out? Okay, we need some information about that. The growth rate of this cash flow for 500 different companies. How do we know that? Okay, we need some information. It will be thrown out to you in the exam. Okay, expectations about this cash flow and then growth. Simply put, dividend and then growth of the dividends. You can obtain it by surveying. And some companies like FN Guide or Data Guide, those guys ask around the analysts in the field. Thousands of analysts, and they ask around, what's your expectation about your dividend payout of these companies, right? And then take the average of it. What's your expectation about their growth in dividend or the growth in cash flow? They take the average of it. So you buy those data, the Bloomberg terminal will give you those things, right? And then what you have to do is solve for those unknown discount rate. Okay? Give me some example. Yes, here it is. So here is S&P US market example. Index is 1418 today. Now 10-year treasury rate, AAA country, that's risk-free rate in 1.81%. Right? Then we need to have some information about the dividend next year. But instead of giving you the information about dividend, here we give you the information about PE ratio, dividend payout ratio, and then expected earnings growth rate, so that you can figure out this dividend amount. Okay? How do we do that? Well, first set up the math. Okay? Your index value, okay, index number, should be nothing but the expected dividend next year divided by R minus G, mysterious discount rate minus the growth in dividend rate, right? And then index value, just put this thing over here. In the end, you won't even need the index value because it's going to cancel each other out somehow, but let's wait for a while. Here, you don't have information about dividend, but you have information about payout ratio, and then some price earnings multiple information. So what do you do? Well, payout ratio 60%, don't forget to multiply it, okay, to your EPS. And the way to get to the EPS is that the idea over here. P times what? 1 over PE multiple. Cancel each other out so that it will be E. Make sense? Let's use that. So take the inverse of PE multiple like this, multiply to the price. That's your index level. And then don't forget it's future dividend, so it has to be growing, okay? And then the dividend should be payout ratio times your EPS, okay? That's what's going on in the numerator. And the denominator is your mysterious rate minus the growth rate. Now what? Just solve for this RM, okay? So that's 5.62%. And don't stop there. Why? Because your final destination is risk premium at the market return, okay? You got the market return. I promise that half of you will stop there and get some points off in your final exam, okay? Don't forget to subtract the risk-free rate, okay? Don't forget to subtract. I promise that I will give you this question in your midterm exam, final exam, okay? It's nice and easy to, bother you. And then, can you throw me some Korean example, Kospi index? Fine. Okay, I'll do that. Here, risk-free rate of Korea, we don't know. We just have 10-year government bond rate. Okay? But I just assumed it to be 2%, okay, after subtracting Korea's default spread, right? Because Korea is not AAA country. So let's just take it as given 2%. Okay? Later you will subtract it from the market return. And then PE ratio of cost-B index companies, on average, that's 17. And then dividend payout ratio is 30%. Notice that this average payout ratio in Korean companies are half of US companies' payout ratio. Is that right? Much to think about. A lot more reinvestment is going on, hopefully. To do what? To grow, right? We hope and pray that we will grow and reinvest more and hire more people. But they're not hiring. They're not growing. I don't know why that's happening. If there's no growth opportunity, what should you do? Pay out as dividend. Okay, that's not a crime. It's called good governance. Okay, and we just keep those cash to the reserve too much. There's something going on. You have to be suspicious about what's happening. So, good governance is about dividend payout ratio. Right? Expected growth rate in earnings 8.4%. Then what is the implied equity premium? Right? So let's formulate it similarly. Right? Cost-B index equals dividend next year divided by R minus G. And then EPS, right? This year grows at this 8.4% rate. Payout ratio should be multiplied. And then because you don't know about EPS, you have to multiply cost-B index times the inverse of PE ratio. What do you do? Well, these two cancel each other out. Now solve for this return on the market, which turns out to be 10.31%. Now don't stop, okay? Because you have to subtract the risk-free rate. That's 2%. In the end, you will get to 8.31%. The next slide shows you some more complicated approach when you are assuming that your market will grow fast over the next 5 years, but stabilize over the following infinite time horizon. Right? The idea is the same, but mathematical model is different. Okay, more complicated. The idea is the same, so you have to solve for the IRR, okay, internal rate of return. Your question becomes like, are you going to ask this question in your final exam, and midterm exam? And my answer is no. So don't worry about it. Just go through this math yourself. In the interest of time, we'll just test this. Okay? Now, very hypothetical and mathematical argument here, discussion. Well, assume that index jumps 10% today, and then nothing else changes. What will happen to the implied equity risk premium? Okay? Everything is fixed, but this guy goes up. That means your implied premium will decrease. There is inverse relation. Okay? Increases, decreases. Assume that the earnings jump 10%, and then nothing else changes, which means this guy fixed, this guy goes up. And what should happen to implied risk premium? It should increase to cancel out, right? Increase. Now assume that the risk-free rate increases to 5%, and then nothing else changes, right? Everything fixed, and then this guy increases. The implied equity premium has to go down, right? Decrease. Or everything fixed, and what if this guy goes down, goes up? This guy has to be down. Make sense? Just a simple math out of it. This one is another example about figuring out the implied premium using two-stage model. Okay, go ahead and do your math, and you'll be able to figure out. Implied premium in the U.S. from 1960 to 2014 team is shown over there. The textbook author was diligent enough so that he estimated implied premium at each time point every year. Okay? Every year there must have been some survey about expected cash flow, expected dividend, and expected growth rate of dividend. Okay? Standing in 1960, based on his best data, okay, in 1960, what is the implied premium? Plotted. The next year, based on the data available as of this time point, what's the implied premium? Plotted. And then all the way down to here. Okay? An implied premium, a time series, tells you that it was fluctuating around 4%. Make sense? And then sometimes it was going up, sometimes it was going down. And if you see when it was going up, well, it coincides with the time of financial crisis or oil crisis. Iran and Iraq war over here. Saddam Hussein, backed up by the US government, fought against the Iranian, right? OPEC formation, and then all of a sudden they say, oh, you're not going to take the oil from our country. Okay? And that's the crisis situation for the US here. Okay? Here, Lehman Brothers related financial crisis to a global scale, right? And then the EU Brexit situation, right? So the idea here is what? When the market tanks, right? When it is scary, your risk premium goes up because it reflects your risk aversion. Remember that SML line, security market line, beta, expected return, and the slope is what? It's the risk premium, market risk premium. That's this guy, up and down and up and down. So when was it coming down? Well, that's 1999, dot-com bubble period. Internet was burgeoning, and then everybody wanted to have some part of investment in dot-com companies. Right? Just give me 2% premium, I'll be happy to invest in your stock. Okay? Crazy. This is a clear symptom of bubble. Okay? If your implied premium deviates this way. Okay? Now, okay. Right. And the next chart shows you the inverse relation between the stock index, S&P 500, and then implied premium. It's like going the other way around. Okay? Inverse relation, we can see it. And the implied premium and the risk-free rate based on the expected stock returns are shown. Just one thing, the author somehow figured out based on expected stock returns, and then divided into implied premium part and then the T1 rate part. But nothing much to say. The only thing that's interesting is that since 2008, the expected return on stock has stagnated, did not change much, but the risk-free rate has dropped dramatically, but which means the implied premium was going up, and then the investors were scared too much over the last decade. And then implied premiums, does it matter? Well, it matters, right? It's important. I mean, it's more recommended to you to use implied premium than historical premium because historical premium may bias you in this way. Okay? Implied premium, we are assuming that the market is efficient on average. Right? Historical premium will be biased depending on the time period that you choose to go. Okay? So in this example, let's say all the analysts in the market, they try to go for historical premium, which is 6%, but your implied premium, okay, is somehow 5%. In that case, what would they likely to find? Well, the investor and the analyst. A, the values they obtain will be too low. B, too high. C, anyway. The value the investors, the analysts will come up, right? They will use 6% rate of risk premium, higher risk premium than what should be used. So the valuation number they will come out is will be lower, right? Will be lower. So all of the analysts will say, oh, the market is in bubble. The correct price should be lower than this price. Okay? By mistake, they will be saying like this. Okay? So try to use implied premium. That's the whole idea. Okay? Which equity premium should you use today? Well, historical risk premium. You can use it, still use it, if you assume that your future will be repetition of your history. Okay? Future will be a repetition of your history. Not a complete repetition, but within the range of what happened. Okay? You can use current implied equity premium if you assume that the market is efficient on average at this point. At each given point of time, on average, if the market is efficient, this is the way you have to go. You can also choose to use the average of implied equity premium. Okay, average of implied equity premium over the past X years. But this guy is different from this guy. Okay, this guy is simple historical average. This guy is first you have to compute the implied premium at each given point of time, like this over here, and take the average of it. Okay. And here your assumption is, well, at each time point, well, the market may be in bubble or bust, right? But on average, over a long time period, the market is efficient. If that is your assumption, you go for this choice. That's that. Another example based on Indian stock market is thrown out here. You can go and do your exercise yourself. Here, next slide shows you the implied equity premium. Okay, for different countries at two different time points. The whole purpose is to show you how the implied premium goes up altogether as the global financial crisis hits. Okay, U.S. market from here to here, UK from 4.2 to 6.5%, Brazil 5% to 9%. Okay, equity risk premium jumps up higher. Okay, in the emerging market, another right. So that's it. Now cost of equity. Cost of equity. That's what we are going after. We're done with risk-free rate, and then we're done with the risk premium. Now the next one is about beta. Okay, beta, our ultimate risk measure. Okay, the regression beta is one approach that you can estimate beta. Another approach is using something called bottom-up beta, and then the third thing is that applying weighted average concept to a bottom-up beta. So how many of you have not taken regression or statistics class before? 1, 2, have not. 3, business statistics, no. 4. So you didn't study anything about regression before? No. Okay. Fine. So before we move on further, people who took regression class before, business statistics, please raise your hand. So who invented regression, please? this point, everybody just